Hi, everybody. This week's episode of Matt's Minutes is basically a follow up from last week's video where I talked about a hypothetical question that I proposed to you all. And that was, what if I were to suggest selling all of your investments? Well, the only way that would ever make you feel good is if the market were to continue to drop after we sold. But my question was, would you rather feel good in the short term or would you rather feel good in the long term? Now, I think that's a rhetorical question. We all know the answer to it. But let's take a look at this visual that has a lot of information on it. I'm going to talk about it quickly. And so what I might suggest you do is push pause. Once you see the visual on your screen, digest all the information and then push play again. Let's look at it together. So to set the stage of what we're looking at here, there have been 9 times since 1950 that the S&P 500 was down 25% or more. Now I want to draw your attention to this column right here that says 1 year. What that's referring to is what the return of the S&P 500 was 1 year after the bottom. More importantly, a couple things to point out here. Number one, there has never been a period of time where the market wasn't positive 1 year after the market bottom. And secondly, this average rate of return down here that shows that it was 46%. Now that's the average rate of return 1 year after a market bottom. Well, you should be asking yourself this question. Well, are we at a market bottom? And I don't know. We could be. We might still have a little bit farther to go. But like I proposed to you last week, would you rather be happy in the short term? Or would you rather be happy in the long term? We can't predict what the market's going to do, but we eventually know where it's going to go. Hang in there. If you need us at all, don't hesitate to reach out. Talk to you soon.